Hello everybody and welcome to the Cyclical Investors Club. My name's Corey Kramer and today I'm going to show everybody how I sift through stocks quickly. I made an earlier video that showed some of this, and we're going to run a little bit of experiment and do a little playlist where I just go through and show everybody how I cover so many stocks and can sift through so many stocks quickly. The first thing that I do is I have certain categories of stocks that I'm looking for, that I've developed my own strategies for. And what I want are stocks that fit into the categories that have the profiles that I think I can analyze and potentially at one point in the future, if they're trading at the right price, make some money from. This incorporates two concepts. One is if you turn over the most stones, you have the chance to kind of find the gems, right? The other is to have a circle of competence where you know what you know enough to do pretty well, like with a certain type of stock, whatever that is, a certain profile of business, whatever it happens to be for you. It will vary from person to person. Now, I have 5 strategies that I use, and so I'm looking for stocks that are going to fit in one of those 5 categories. So in this video, I'm going to tell you which category they fall into. And then there's basically 3 categories stocks fall into where they don't fit into the one. So one of those are stocks that don't have enough data, usually earnings data. The other ones that are stocks that are just for one reason or another are too hard, like they're too complicated, they're in industries that my strategies don't work very well with, or they just don't fit into what I do. So it doesn't necessarily mean there's anything wrong with them, or they're bad, or that somebody else couldn't make money, but it means that I don't feel like I'm competent to do it, or they're just not a good fit with the strategies I've developed so far. And then the last one is they're just low quality. Like I can kind of see they don't fit the quality metrics that I want. And the basic quality metric is I want businesses that can grow earnings faster than inflation over the long term and that have a history of doing so. That's the basic one. There'll be some more that pop up, and that's why I go through these one by one. So I'm going to go through the first 33 stocks. They're the ones that all start with A in the S&P 400 mid-cap index. So mid-caps are good because it will give a more variety of kind of, the S&P 500 tends to be pretty high quality. So you don't get a full taste of like what categories more stocks fall into. If I did like small caps, 90% of those are not going to meet any of the metrics that I'm trying to find. Usually because they're small, because they were once big or medium and they shrunk. So they're obviously not growing, right? And that's my main metric. So, but the mid caps will give a good mix of everything. And I'm going to do all the ones that start with letter A in this video. And wherever they fall, I'm going to tally kind of where they fall. And then we'll collect data on all 400 of these companies over time with a series of videos. And then we'll look at the data and we'll kind of see what it tells us, about my strategies, how many, stocks fall here and there in terms of where they might be interesting to analyze or to track. So I track about 600 stocks in a spreadsheet. The ones that meet my standards get into the spreadsheets, or that meet most of them as standards anyway, get into the spreadsheet. And then if they fall to the right price, then I know that I'm ready to buy them. I've already done kind of most of the work on them ahead of time, so I can act very quickly if the prices do come down. So I'm going to use Fast Graphs for this. I have a 25% off link for Fast Graphs down in the description now. I didn't have that in my first video, but people did find it useful. It's so yeah, if you think this is honestly the primary thing I use Fast Graphs for, I definitely use it for earnings analysis and things like that. But in terms of, it doesn't cost very much really, and when I can sift through hundreds and really thousands of stocks that I've done now, about one per minute, and get them and narrow that list down really quickly, it saves me a lot of time. I know pretty much what I'm not going to be working with, and then I know the ones I need to spend a little bit more time and more detail on. So it really helps with that. So that link will be down in the description if anyone is interested. And honestly, just another note, you want to find most of your stocks using this method. You don't want the media to tell you what stocks you should be interested in, because those stocks have almost always, the prices have already moved. They're really just trying to get people excited so that somebody else can sell the stock to you at a high price, and then they make money and then you don't. So you need to be able to, in a perfect world, kind of analyze your own stocks and at least know a big chunk of the ones that you don't want to buy, or that don't really fit what you're trying to accomplish with your goals. Okay, so with that, let's get started. Alcoa's first. So Alcoa I would say is a deep cyclical, but because earnings have not reached these old peaks back here, and really even since then we haven't had a real recession to test these kind of new peaks that they seem to be making, I would put this one, it would either go in the not enough data or too hard. I mean, you can kind of take your pick. I think I'm going to go with quality for this one, because I really, when I'm looking for a deep cyclical business, I want to have a lot of confidence the next cycle is eventually going to come in a timely manner and be sufficient for me to make money. So I would put this one in the low quality category. Okay, next, ACHC. Acadia Healthcare. This one I would put in the not enough data, because we don't have a real recession. We have kind of this weird, it could either go in no data or too hard, but since I don't have a 2008 recession for this one, or like a normal recession that wasn't COVID related, I'm going to put this one in the not enough data category. Okay, ACM. These green shaded area is what I'm mostly looking at. This is earnings, previous earnings. And so what I'm looking at is for the patterns in here to see if they might fit into one of my strategies. So this one's a little different. What is this? Construction and engineering. Okay. So side note, something I wouldn't have thought to talk about. I don't usually buy construction and engineering stocks anymore, because a lot of times they'll one, I had one that went bankrupt on me, and I learned a pretty valuable lesson, and that's these guys will bid out, they'll try to get contracts, and so they'll put out, quotes for work for contracts. Generally, I'm just talking generally. I don't know anything else about this business other than the industry that they're in. And if they underbid their competitors too much in order to get the contract, then when the actual expenses come to build out the project, they could lose money on those if they don't get the bidding right. And this can be really, it's very hard to predict. So what it means is that all these past earnings, well, it's kind of good that they're okay. They aren't necessarily predictive of the future. And so for me, I found that these are just too hard for me to analyze using my methods. I don't think previous earnings are a good enough predictor, we'll say, because it really just takes a few mistakes for some of these companies, and then they get in big financial trouble. And there are structural incentives for them to try to take on that risk, right? Okay, ADC. This is a REIT. So when it comes up, what I want to see here with a REIT is a good historical pattern of higher stock price. Basically, we're kind of in a muddling around a little bit here. So this is from a peak, right? I didn't pick like 2009. So even right before the worst kind of real estate recession, and then during a real estate downturn right now, there's still decent returns. I mean, they aren't great, but this would be one that I would put on the list to watch, because they do have a long-term track record that's at least okay. I wouldn't say it's great, but it's okay, given kind of where we're at right now. ADNT, okay. Okay, these guys, there's not enough data. The data that we do have show a big downturn. What industry are they in? Auto parts. Yeah, so this is probably a cyclical, and I would say we don't have enough data really, so to know what kind of quality it has, because we don't have like a normal kind of recession. So this one goes in the no data category, or not enough data. AFG. G. There we go. These guys are asset manager, I believe. Okay, so This earnings pattern is okay. There's a little bit of cyclicality, but the general trend is up and pretty solid. You get these bumps every now and then. Now, what I do find interesting is that relative to the adjusted earnings, the stock price actually does move a lot. So this isn't a category that I broke down. This is more of like a subcategory. I wouldn't be surprised if this is a 75% drawdown. Yeah, I probably would have if I would have picked the peak. And then you can look at the COVID one. Let's see if I can get rid of all these. You can look at the COVID drawdown here, and it's probably going to be bigger than the market, because what we see here is, even though earnings, the adjusted earnings aren't super cyclical, yeah, so this is down twice as much as the S&P 500 almost during that little March crash. I really actually do like these stocks, so I definitely want to track this one. So it has steady enough earnings, but the price is actually cyclical. And these can be really good stocks to make a lot of money on. If you can buy it, well, I'll just show you. If you would have bought it in March, I bought a couple that were like this. I didn't actually get this one. You can see you have 158% return if you would have bought during that March crash, because the market just gives you these really deep opportunities, because it gets really sketchy about these. A lot of times there'll be asset managers. I'm not sure what they cap. Okay, this one's insurance. Sorry. So they do actually have financials that they are managing, but you can see that price cycle pattern, and that can be pretty lucrative if you get a high quality one. So yeah, this is definitely one I would want to track. Okay, but it's not a cyclical. Just the price is cyclical, not the earnings, which is not deeply cyclical anyway. All right, AGO. Okay, so this is deep cycle. This is deep cycle. We look like this looks like another auto. Agriculture. Okay, similar. Oh, I think I just looked at this one for someone the other day. All right, so we have, it's deeply cyclical. It's high quality. We have higher peaks, higher peak, higher peak, higher trough, higher trough, higher trough, probably higher trough. I wouldn't count on this bottoming here. I would count on it bottoming lower, but this is a quality deep cyclical, so I would definitely consider tracking this one. All right. So AIRC. This looks like another REIT. Okay, so with this one, we don't have enough data. Okay, for REITs, minimum 2015, basically. And I really prefer like before 2008, because I like to see what they did all the way back then. But some of the newer REITs it's a little bit of a tough ask, because that's like 15 years ago now. So if it looks pretty solid, I might be tempted for a few that are a little newer than 2008, but I want to see pretty strong results from them. I own a couple of them, and they've done well though, so relative to other REITs. All right, let's see, ALE. This one, we have some cyclicality. We have some decent growth. Yeah, I mean, it's not great, but I mean, I think I would track it. We'll track it just as a full cycle stock. There is some earnings cyclicality, but it's not super deep. Usually it's pretty moderate, so that would just be a normal earnings-based analysis most of the time, unless I found something different. ALGM. Not enough data. Ally. So with an Ally, I think these are consumer finance, yes. So this is these guys like lend money. I think I've seen their commercials. I definitely want data before 2008. That really, during the downturns, are the only time that their risk can get exposed, really. So if I had to bet, these guys are making riskier loans probably than you might think. And so I would want to see proof that they could get through a downturn and recover, and we don't have enough data for that. Again, another one, not enough data for lithium. Okay. ALV. So with this one, okay, this is interesting. So definitely deep cyclical, definitely good recovery. Another down cycle, another pretty good recovery. So what do these guys do? Automotive parts. Okay, we have a very strange automotive section, kind of cycle going on right now because of stimulus and COVID and supply chain. So these guys are at an all-time high right now. So it's not like I would consider buying them, but I would definitely track them as a cyclical because they bounced back pretty solidly from all these. And the market definitely gives some opportunities here. This looks like it's a big drawdown. Let's just check. 80%. So that's probably really more like a 90% from top to bottom. That it could be a big winner if you get everything to align right during a down cycle. So yeah, I would track that as a deep cyclical. Antero midstream. So midstreams, MLPs. I'm not sure if this is an MLP or not. It doesn't look like it, but basically kind of these midstream business. There's not enough data here for this one, so we'll just categorize it as no data and we'll move on. AMED. Okay, so we have plenty of data here. These guys are healthcare services. Big kind of boom here, super cycle. When I warn people about super cycles, this is what I warn them about. So 70% losses in the last 2 years. The earnings cycles with this are quite strange. This is a weird down cycle. It was long. It took a long time to come back. So for me, that's just it doesn't really fit. If it was cyclical, I want it to come back quicker than that. I would call this one too hard for me to kind of understand or not a good fit for my strategies. AMG. Come on, here we go. So this looks pretty decent. A little bit of cyclicality. This is a little unusual to have the stock drop this much with earnings still up here, even though it does kind of follow earnings. So this is one I would maybe peek at basic unadjusted earnings. And then we get a better view here. So basic earnings are quite cyclical. The stock price typically tracks that more closely. We just had a big boom and we're in a down cycle. I would just, this won't go in the too hard category for me. We can tell that the market doesn't really care about whatever adjustments they're making in the market to their earnings. The market doesn't care about what their adjustments happen to be. AMH. American Homes for Rent. Okay, this looks like another REIT. Yep. Yeah, I mean, let's just see. We have 2014 to here, 100% return with dividend. Yeah, I mean, this worth tracking. It looks like it tracks along pretty good with their fundamentals. I think it's worth keeping an eye on, even though I don't have the 2008 data. Those, like a rental real estate business is usually relatively simple compared to some. I'm not a real estate expert, but when things are more complicated, it provides more opportunity for management to kind of make adjustments that don't make sense for the investor. Not quite sure what to do with this one. Earnings are very choppy, really weak period, and then we have a boom. So what I would say is this is probably, what do these guys do? Semiconductors. So this could be AI and kind of just the general tech boom that we've had here. Earnings actually fell a lot this past year, which would be normal. Why the stock price is up here, I don't know yet. I think maybe the market's getting ahead on some of these assumptions. But what I would do is, before COVID, which we can call weird, their earnings were trending down. To me, I would put that in the too hard category. I want something that's more clearly on a positive uptrend rather than just the current boom, which is already in coming back down. I don't know where it will bottom. You know, it's just one of the things I don't know. So that one's too hard. There are easier opportunities out there. Let's see, what was that? I think it was, yeah, we're on AutoNation. All right, AutoNation. Okay, so we can see the auto profit boom anyway. Up until then, it was kind of ho-hum, it's pretty decent earnings. Let's just go here. All right, so we have moderate cyclicality. Stock price follows the earnings pretty well. We have this current boom. I would call this like a boom bust risk, but I would consider tracking it to see what happens. They had pretty decent earnings growth leading in. I think I do actually track this one already. So AR, but chances are I won't be buying it anytime soon. But you can still track them as long as if the metrics look okay. So this one's going to be not enough data, especially since it's probably cyclical in the energy space. ARMK. Not enough data. ARW. This one looks pretty good. Again, we have this electronics boom. Pretty cyclical back here. I know I tracked this one for a while. I think they had like a spin-off or something. Yeah, I mean, this is one that's maybe worth keeping an eye on as a cyclical, I think. So I put it in the deep cyclical category. ARWR. Pharmaceuticals. Okay, so my strategies don't typically work great with pharmaceuticals unless they're kind of the big ones where, you know, they're constantly coming up with like new drugs and things like that. With these guys, they had 1 year where they had earnings. You can see the stock price jumped like 1,000,000 billion% here. Very briefly. 4,000%, right? So these aren't the type of things that I want to invest in. So that one would go into too hard for me. I just don't have... for a pharma that's not earning any money, that's not really what my strategies are set up to do. Okay, so where were we at here? ASB Bank. It's good. I don't think I've had a bank yet. Okay, so this is a regional bank. Yep. So this is actually not bad. They got hit hard during the financial crisis. They came back pretty strong. They got hit during COVID. Okay, that's okay. They bounced back pretty strong. I would say this one's okay, but regional banks usually trade very similarly with each other. So you can buy the highest quality ones during these drawdowns, about the same you can buy kind of the borderline ones, which is what I would call this one. So I'm going to put this one on not quite enough quality, just because there's hundreds of other regional banks you can choose from. So unless you had some other compelling reason to buy that one, I would say it's just kind of on the edge. ASGN. So this looks good. I mean, oh, we have a big drawdown here. That looks cyclical. Looks like we had a boom and another drawdown. The price looks quite cyclical. Let's see what they do. Human resources. Okay. So human resource stuff, for the most part, I've just started to avoid. I'm going to put it in the too hard category. With AI and everything like that and kind of deglobalization to some degree, I think it's just going to be really hard to confidently predict these type of businesses' earnings over the next, say, 5 years. And so I have bought one or two of these in the past, and I think they've just kind of tipped into the borderline area where it's kind of like construction and engineering. I think it's just going to be too hard to predict with the technological changes that we're having, unless you really dug into one of these and really understood it. But at this phase of the sifting process, it's going in the too hard pile for me. Okay, so it's funny, it says it's in industrial though, so maybe there's something else Is that the same one I was looking at? Yeah. So maybe there's something else going on there that I don't quite understand, but still, it's probably not gonna. It's not an obvious good fit for the type of things that I do. So, okay, Ashland. We have this. This is kind of a funky little earnings pop that could have been from anything. So sometimes you can ignore those. The overall trend was up until about here, and then it was basically flat until COVID. Pretty deep earnings drawdowns. I mean, it's a chemical business. Probably, I mean, I can put it in the deep cyclicals for now. It's kind of borderline. I would probably be able to find something a little bit better, but that has similar characteristics. So Apatar. So these earnings, they aren't growing super fast, but they're growing super steady. Stock price looks really high to me, but that's not what we're worried about right now. So yeah, this one would definitely be worth tracking. If the price ever got cheap, I would consider buying it. Just looking at it there. Looks like they make metal containers, so they could have kind of a down cycle at some point. Or just sometimes investors forget about those companies. They aren't forgetting about them right now because they're such steady earners, but okay, so this looks cyclical here. Cyclical during COVID, and it was before COVID, or at least volatile. Pretty big stock price movements. Another chemical company. Yeah, this could work as a cyclical. We have an overall pretty good trend with higher highs and higher lows. So yeah, I'd be willing to look closer at that one. Where are we at here? AVT. Getting close to the end. Okay, so this looks pretty weak to me. I mean, if you cut off the COVID era, the past like 10 years is no growth, basically. Yeah, it looks like there's quite a decent amount of debt there. So yeah, this one probably just isn't quite high enough quality. I know that they got this earnings bump recently, but you can already see that it's coming down. The stock price didn't even react to it. Yeah, that one's probably just not quite enough high quality. If you looked at earnings growth from like here to pre-COVID, it's basically down. So it could return to that, and it's just not quite enough for me. AXTA. Not enough data. And probably not enough growth. I mean, if this was growing at like 15% here, it could maybe go into the growth category, but it's not quite. The earnings at least are not growing fast enough for that. AYI. Yeah, this one looks worth tracking. A little bit of a downturn, which you would expect during the Great Recession. Now the stock price has gotten totally crazy a few times, but the overall trend is okay. Yeah, I mean, I would track that one. Keep an eye on it. Maybe run some numbers. AZPN. Aspen Technology. Again, not enough data as a growth stock. Probably too slow. So I would put that one in no data. And then last but not least, AZTA. Azenta. Yeah, I would just say this doesn't look very predictable to me. It looks very unpredictable. The kind of COVID boom bust, and now they're really down back to where they were here. So yeah, I would just say it's too hard. There's just not enough of a pattern of any kind to go there other than this boom bust during the COVID era. Okay, so we have, I think there were 33 of these when I counted them. If I'd marked them all down, we should be close to 33 here. So in terms of the categories that don't fit any of the strategies that I use currently, that I can just kind of put off to the side, maybe check it back in a year or two. No data had 11. Too hard had 7. So what's that? 18. And then 3 were a little bit too low of quality. So that gets us up to 21 that did not fit anything that I'm trying to do. So 2/3, almost exactly. 2/3 of the 33 we can just now, we spent 1 minute each on them. They're off to the side. We don't have to look at them again. The other 12 or so, yeah, the other 12 I had 5 that fit the full cycle / kind of earnings based analysis, 5 that were deep cyclicals, and 2 that were REITs that looked okay, or at least worth kind of keeping an eye on. I would say after I look closer at some of these, you could trim a few more probably once I kind of got a little more strict, or I was like kind of what I did with the bank, where it's like, well, if you have 4 chemical companies, you know, you only really need to pay attention to the 2 best ones because they're going to trade a lot of times similarly. So you can kind of pick 1 or 2 apart that way. And then when you look more closely at the business, maybe there's some other factors in there that you find things that you might not like, so you can trim it down a little bit more. But you can see how quickly you can take this vast universe of stocks. And if I was going through the small cap index, where there's like 1,000 stocks in like the S&P 600, yeah, maybe less than 100 would even be interest me at all. So these are better than them. And then in the S&P 500, usually it's more like half, or maybe even 2/3. It might even be flipped that I would be interested in, and about 1/3 where I just don't have the stuff that I'm looking for. So yeah, that shows you just how quickly you can do it on your own, and then you don't have to listen to these guys on the media talking about whatever, you know, they want you to pay attention to. A lot of times the stocks that nobody's paying attention to are just the easiest ones. I mean, I posted some on this. I made a few videos back in 2021, and I posted them, a few of them back in early 2021 when the market was kind of near a peak, and things like defense, healthcare, nobody was really paying any attention. I think I bought Meta back then too, when it was Facebook, and nobody just cared about them. They were boring, but they were cheap and they had a good history, and you just quietly buy them and they go up, you know, like I think almost all those are up 70, 80. I think it was ABC, AmerisourceBergen, and it changed their name, but they're up over 100% since then. And you really do nothing once you buy them. They just sit there and like make you money. So but nobody was talking about them. Nobody was talking about them. Nobody was paying any attention. It was all meme stocks and crypto and whatever else they came. Then SPACs, right? That was just during the peak of all that, and everybody's paying attention there because that's what everybody's talking about. And you go and look in the market, these stocks are up over 80%, and all that other junk is down, you know, if not like 80-90%. So that's how you have to do it basically. And if you can sift through them quickly and know what you're looking for, Fast Graphs is a good tool for that. Okay, thanks everybody. If you like this, hit the subscribe button, like button, and I'll see everybody later. I'm going to keep occasionally posting these, and I'll put them all in a big playlist, and we'll go through the whole mid-cap index.